This is Traders Workshop with Adam H. Grimes. Hello, and welcome to episode 19 of Traders Workshop, and to the first episode of our mini-series, The Trader's Journey. I'm your host, Adam Grimes. You can find more of my work at adamhgrimes.com, and you should follow me on Twitter at adamhgrimes. So, a few weeks, maybe even a few months ago, Tom came to me with the idea to teach his friend Alex to trade. Now, Tom and Alex have been friends forever. They grew up across the street. Alex, as you are going to see in just a few moments, is not a complete beginner. Alex has a business degree from Stanford, MBA from Oxford, and he's worked in the finance industry for many years. However, he is a complete beginner to the idea of technically motivated trading and to the idea of trading for his own account and own risk. So what I hope you're going to see here is over the next weeks to months, you're going to see Alex move from being a complete beginner to some degree of competence and hopefully to consistently profitable trading. That's the goal, and along the way, we'll see what happens. So with no further ado, here's the podcast. Okay, so I'm here with Tom and Alex.
Hello. Hi.
And we're sitting around my table drinking a bottle of Beaujolais, which is a good wine for trading discussions, we found. Actually, most wines are good wine for trading discussions. And Alex, tell us a little bit about your background, like where you're coming from, what you've done.
Yeah, I guess my interest in the markets was lapsed for, let's call it 5 to 10 years. I spent about a half decade working for an equity long-short hedge fund based in Silicon Valley with, as expected, a tech focus. But I've since moved more into what I would call traditional corporate finance. So I'm a finance guy by background, lapsed in terms of my involvement in the markets, but recently sort of taken a renewed interest. Again, pretty new to the whole technical world.
Okay.
And
is it fair to say a little slightly suspicious, maybe?
Correct.
Okay.
I'm not going to go out and call it sort of divining the stars, but it sort of has that reputation.
Yep.
Yeah, I'm a sort of, I have a background in the game, but I'm sort of open to a new approach, and I think that's frankly why I'm sitting here at the table.
Cool. So if we say technical analysis, I just throw that word out. What does that mean to you?
I would describe it basically as the use of pattern recognition to make trades.
Okay.
So, for instance, if you juxtapose that against a fundamental approach, which is typically catalyst-based, financial statements oriented, my understanding, which is limited to be fair, is it is the utilization of, again, known patterns to sort of understand uptrends, downtrends, make trades.
Okay. So when you say patterns,
Yeah.
What do you mean?
I mean, effectively, that the price history, the chart, creates certain identifiable, shapes or trends,
Okay.
and that based on how that sort of indexes against a sort of known catalog of shapes and trends indicates the future price action.
So kind of like if someone, like a Head and Shoulders pattern, and someone would compare the chart against what the Head and Shoulders pattern looked like in the book.
Absolutely.
Yeah.
Did anyone at the hedge fund you worked at, did anyone there use any
Zero.
sort of technicals?
I
Zero
don't think the
technicals?
word was used in that context in any time.
What would have happened if somebody had whipped out a chart? And you're already
to be honest, exactly.
Yeah.
I think that's it.
Yeah.
You basically get left out of the shop.
Right.
Yeah. It was a small shop, so there's only so many people could laugh at you. But I think
Well, they all would have been
yeah.
So I think the way I would kind of rethink the technical thing is using information based on past movements of prices. Now, I think when you talk about pattern recognition with charts, Like to me, that's a specific subset of technical analysis. But I would argue that like all of your risk management stuff, you had risk management, right? You had portfolio stress tests, you had risk metrics, like you knew how much you thought things could move tomorrow
Sure.
on a bad day. Where does that information come from? Right? So I think really what is happening is like this is kind of baked into a lot of our discussions about finance already, because you have to have some awareness of how the thing moves typically, of how risky is the stock or what's the beta of the stock, right?
Sure.
And that is, to me, that's very clearly technical analysis. And the divide is, at least in my mind, is if you're using fundamentals, you're using kind of information that's outside or beyond the price movements. That you're using, as you said, financial statements or conversations with management or competitive, and all of the things that we might bake into that. And I think maybe technicals, because Tom and I, we were discussing this, technicals have a reputation for being pretty subjective, right?
Yes, very. Well, yeah.
Yeah, because like you could put up I remember when 2008, there was this chart going around, people had like this two dogs humping pattern. Anybody can look at a chart and make up any pattern they want. And the question is like, what's real?
Right.
And what do you, but there's also this idea that fundamentals are kind of written in stone. I would argue that's not true. How much subjectivity do you think goes into fundamentals? How did you do your fundamental analysis, just broadly? Like because that's a wide field too.
Yeah, I mean, without getting too into the weeds, I mean, effectively, we probably had a standard set of sort of relative value multiples, price to sales, PE, probably a raft of others. It's 10 years ago now.
Sure.
And then effectively, I mean, it's pretty simple, right? It's simply what is the individual assets score on those metrics? What is that over its competitors in the market? And therefore you have a relative value proposition or not.
Okay. So your work was almost purely relative value.
Yeah.
Okay. And I guess many of our listeners know this, but it's probably worth having a discussion. Correct me if I'm wrong, but in my mind, fundamentals kind of divide into either relative value, which is all the PE ratio. And a PE ratio is kind of meaningless by itself. You have to compare it to other companies. That's why we're talking about relative. And when you compare you have to have the right comps, the right comparables, right?
Yep.
So you need to look at a similar company, similar capital structure, blah, blah, blah. And that gets, you as you said, you kind of get in the weeds there. But then there's also what I would think of as more like absolute fundamentals where you're building models, right?
Yep. And we definitely did that too. I would say, honestly, we were probably much more driven by the relative value metrics. Certainly, I did spend some time building models, but I think it was the sort of investment decision was largely a combination of indicators from those relative value metrics, and secondarily, shall we say, grassroots research, insight, and into sort of effectively the color that might complement.
Which sounds a little subjective to me.
Totally.
Right.
Totally true. Yeah.
And it kind of comes down to, at the end of the day, whether the portfolio manager wants to buy it or not.
Yeah.
Because you can really put your thumb on these things. Like with Tom and I were also discussing about building like just kind of cash flow models, where to me, that's a terribly creative exercise sometimes. Because what do you first of all, how much of your value is in your terminal value?
Yeah.
How much will your
Usually
stock
huge.
valuation swing with your discount rate? What's the right whack, right? And then, like, I remember I was building a model at one point, and I thought, what the hell do I know about what some manager's going to do with CapEx in year 5?
Yeah.
Like, how do you possibly make these decisions?
Totally true.
My argument is that I think there's this idea that, let's just face it, fundamentals make a lot more sense if you come from a business school background.
Yeah.
Because we learn accounting, and accounting is incredibly valuable. I think most people who learn to trade should probably learn accounting. But then fundamentals kind of work within that language. But what we miss, I think, is the point but there's still a lot of subjectivity. Am I wrong about that? That's
Absolutely. I mean, the short answer is all those points you say. How much of the value of the stock do you kick into the terminal value, which is usually based on a WACC? Absolutely true. I think what's comforting about fundamentals is perhaps why it is probably the predominant approach in the traditional investment community. I hope you don't take that as a negative.
no, it's fine.
Is it feels well supported. It feels like it integrates sort of catalysts that might create change, and at the end of the day, I can explain the story. And if an investor asked for it, I could pull out, to your point, what can I do with year 6 capex? But I can pull out a 10-year financial forecast and feel relatively comforted that it's robust, even if it's assumption laden. Yeah.
Right. But if I'm your investor, I'm going to say, what if we change that discount rate by 25 bips?
Completely.
Where are we then?
Completely. Yeah.
Why does your stock valuation swing 800% when you and I think that is like, this is all so subjective. There's so much. People like to think that this is a science, but I think anything we do in the market, and like Tom and I have talked about this, like there's that element of art. There should be that element of art to it, right?
Yeah, definitely. I think that people sort of maybe underestimate the amount of subjectivity that is in fundamental analysis, like we were just saying. So, and I think something that maybe we could talk about in a future podcast is just the amount of, well, that the chart sort of leads the fundamentals.
There's a good point,
Yeah.
too.
So if a lot of the fundamentals are baked into the chart could be telling you things that aren't necessarily reflected in the fundamentals yet.
That's a pretty good argument, actually.
But obviously the counter argument is the fundamental guys feel the fundamentals drive the chart in the first place. So it's a chicken and the egg.
It all is, right? But like, for instance, on a macro level, let's say we're going to step back and we're going to look at when the economy turns into recession.
Mm-hmm.
Okay, and we know the macro factors that might influence that. Like, you're going to see a fall off in consumption. You're going to see durable goods orders go down. You're going to probably going to see some moves in inflation. The interesting thing about that is if you go back and look at the historical record, the stock market was weak every time first. So I would actually make the argument that people who are trying to predict the stock market with fundamentals, the stock market is the leading indicator.
Right.
And you can, Tom and I were also just discussing 2007, 2008, 2009,
Yeah.
that there were weird shocks in the market in the beginning of 2007. Purely, I still to this day don't know what caused. There was a huge random decline in late January, early February of 2007. Market just got whacked. Do you remember that?
Sure.
Yeah. And
I was actually fully employed in the investment world at that time. Yeah.
So do you know what happened? Because I actually don't. I don't know what the catalyst was.
No.
Okay. No,
My
never.
vague recollection is I think some of the cracks in the mortgage and banking industry started to show themselves.
Okay. So, like, I build a lot of fundamental models looking at various aspects of, say, employment or credit stress, and it's extremely easy to build those models to predict recessions because they lead. Clearly, the data leads. It is extremely difficult, however, to use those in an investment stance because the market's already moved. And you see that just looking over the past 20, 30 years of data, and that's another discussion, like how far back should we really go to be relevant. So my sense clearly is at least the market leads.
Got it. But if I take a step back, immediately my thought is, it sounds like an autonomous, driving vehicle. I mean, presumably, the thinking would go that cute chart up or down is the reaction in the marketplace, and it's not its own spirit.
It's not. You're absolutely right.
It's maybe some combination of sort of general level evaluation, incorporating all those economic inputs, etc. Maybe it's order flow, but
Right.
it's not its own beast. It's the outcome of the interaction of, generally speaking, relatively autonomous, atomistic agents, each making a choice which drives a visible outcome, if you will.
It's kind of group mind thing.
Group mind, right.
Yeah. I think that is, so your question at the beginning, the skepticism toward technical analysis, I share. Yeah, I'll put that out there. I used to tell people, I don't think we can say 4-letter words for iTunes, but I used to tell people that I think technical analysis is mostly bullshit, but I'm a technical trader.
That's going to be a hard one for me to reconcile.
It's a little bit, but what I mean by that is that I think a lot of the discipline just doesn't hold water. And particularly some of the chart pattern stuff like you're talking about, I haven't looked at a Head and Shoulders in 12 years. Like that's just it.
I look every morning in the shower.
It's a
oh
my God. We'll get a sound effect for that.
Yeah.
And like all of the ratios that people talk about, like Fibonacci ratios and Gann ratios and mystical codes from the Bible. There are people who make investment decisions on that. There are people who believe that I have arguments with people who, it's always funny, like you get people will be like, mathematics is the language of God. And of course, you're talking to somebody at that point who's never worked a differential equation, like
Yeah.
But they feel very passionately that there are all of these secrets that, and then when I don't get it, they're like, "Well, you're just stupid. The markets are perfectly predictable." And of course, these are not wealthy people telling me.
Not the wealthiest people in the world.
No, oddly enough, they're not. But I regularly have interactions with people who say, just because you don't understand the secret ratios doesn't mean they exist. Well, I think all of that is garbage, because I think you said something that's very true. The only thing that moves prices is somebody buying and selling, or maybe somebody having the willingness to buy and to bid it up at a higher price. But there's nothing mystical or magical or at all hard to understand about this. You get a bunch of people, and it's a very competitive environment. They look at all the information, and they look at how they're feeling, because there's also that behavioral aspect baked in. And then somebody makes a decision to buy or sell something.
Do you think there's an edge to fundamentals, Alex? Like, do you think an individual can get an edge, doing fundamental analysis?
I would say that probably, this probably goes against my work in my former employer. I think the high-level metrics that people use are so widely distributed and baked in, probably not. I think there's potentially an edge. I don't know if you call this fundamental analysis, but to your point about business school, deep accounting investigation. So you talk about it's a bit of a sort of pop cultural reference, but Michael Burry, who actually read the loan documents, and you find things. People who can actually read a 150-page 10K might find something. That's clearly not technical analysis. I don't know if it's exactly the sort of relative value metrics-based thing, but I think that level of rigor is potentially a differentiator. But no, the answer is probably not simply looking at the summary 5 statistics you get on a Google Finance poll on Ford or whatever.
Right. You've made a few. I know you've started to dip your toe in the market again recently. Like what led you to pull the trigger?
Half my leg in.
Yeah, you did. But what made you pull the trigger?
I feel like there's a risk management discussion coming somewhere here.
What made me do that?
Because it wasn't technically driven, right? And then you're saying a lot of the readily available fundamental data really doesn't provide an edge.
No, it's entirely personal circumstances.
Yeah.
how do I put this in a way that sounds like I didn't have a long lost rich uncle? I came into money in a way, and obviously the interest rates are no return at all,
non-existent.
It's the world's most accessible casino.
So you went to Vegas. Is that
Well, no, I stayed here. That's the best
Right.
part because I saved the flight. The cost of a flight.
right. What did you do roughly? I mean, Tom's kind of filled me in on. I know some of what happened here, but just tell us a little of your first trading forays here.
Um.
Well, would you even call them trades?
Oh. That sounds like there's a sort of. I'm gonna come up with an answer that's a distinction without a difference. What do you mean by trade?
Well, I guess when
versus-
you, in your mind, when you made these decisions to buy or sell, were you thinking this is a trade, or were you thinking this is an investment, or were you thinking neither of those things?
I was thinking probably more the trade side.
Okay.
What I would call short to medium term price inefficiencies. So this isn't, and frankly, I'll just for the first podcast, sort of restrain myself in terms of mentioning the actual
Okay.
trades involved.
Fair enough.
But in effect, seeing quick money, easy wins. I'll say occasionally that it's the historical outcome has largely supported my instinct.
So you,
But
make,
I don't know if
you,
that
you
is
make
in luck.
money. You
Yeah,
make money
yeah.
on the trade. Okay. Let me nail you down on a couple things here. Short to medium term. What's that mean?
Let's call it 1 to 3 months.
Okay.
Yeah.
Because that can mean very different
Yeah,
things to
yeah.
different people. So 1 to 3 months. Price inefficiencies.
Yeah.
Tell me more. Tell me more from your fundamental perspective. You get
Sure,
see
sure,
where-
sure, sure,
yeah,
sure,
you see
sure.
where we're going here.
Basically, what I would say is the pricing, the market price was so low. These are all longs, to be quite clear.
Okay.
The pricing was so ludicrously low that all of the avenues, assets, opportunities of the stock clearly couldn't be there. So, again, I'm not going to mention a name, but it was effectively a near bankruptcy price.
Okay.
And I'm not saying it's a good stock. I just know it's probably worth more than zero.
So it's fair to say that you looked at the price, that the market price of the stock, and you kind of did some, whether actual analysis or back of the envelope, and you were like, if it goes bankrupt, it's probably worth this a share.
Yeah.
And you okay.
So
So you were able to kind of put a floor based on that analysis,
Yeah,
and then the fact that the price was there, it was buy.
absolutely.
Okay, fair enough. I think that's obviously now we've also used the word catalyst. What's that mean to you?
Catalyst is some insight, fact, or sort of other contributor to performance that one believes isn't fully reflected in the current stock price. So it would be, just sort of generically, underappreciation of Asia sales for a retail merchant.
Okay.
Obviously, immediately, I would ask myself the following question, which is, why do you believe you know something?
What are you missing? Right.
How do I know that nobody else does?
It's also this big game of chicken, right?
Right. Yeah.
Market's wrong. Wait, I'm wrong. The market's yeah.
It's obviously, look, at the end of the day, I'm an individual trader. I don't use sophisticated platforms. I don't have every sell side firm sending me research every morning. So I'm in and I have a job. I have a day job. So I don't have the ability, in theory, to compete with the best of the best. Which calls into question, frankly, why do I believe that I would know a catalyst that isn't fully priced or best priced by, the marketplace? So you could call it some level of faith.
Okay.
But
So in this case, you bought the stock.
Yep.
What if it had gone down? What was your plan?
Well, you'd like to have a
I mean,
stop loss or something?
I know you're thinking like, oh, it can't go down because this is, but we know like the best analysis can be wrong. Like, what would you have done?
Look, it's like if I was playing blackjack, which I do. I basically know the amount of cash I'm ready to leave on the table.
Okay.
So yes, obviously, if it's going down from almost 0 to 0, that's still potentially 100% loss.
Right.
You can't change that dynamic at any level. But I know, at least roughly mentally, what I'm willing to give. And so as long as I keep, let's call it, a daily check on the price, I'm ready to sort of
So you knew
sell out.
roughly like when you would get out.
Yeah.
Yeah.
I can't specify a price, but it would be some level of sort of dormant understanding that at a certain level of percentage drop, or let's call it a dollar value, I know I'd get out.
Or maybe something changed within the company or the news or something, and then
I will say that probably the and I think this is probably like the gambler's fallacy, which is I'm pretty happy to play with winnings. So when you have a nice run up, which I have, even if part of me is willing to effectively double down on the thesis, to use the blackjack reference, comfortable in that, well, even if I give a little bit back, I still probably made money.
Let's just make up numbers here, and let's say your bankruptcy price was $100.
Sure.
Okay. Now let's say the thing was sitting at $100, and now it goes up to $150, and you're a genius.
Right.
And now you're playing with the market's money. So now you're going to double down.
Yeah.
But now aren't you kind of far from your bankruptcy price? Because like it could go back to 100. Like you buy a bunch more at 150, and it goes like, what do you do then?
So typically, I mean, at least in this one case, I'm not saying it's a general investment strategy. To be honest with you, I'm, like a tourist down in Atlantic City. I take out a lot of the gain. So I will probably, let's just say I had 100 shares at 100, goes to 150, I probably back out 50%, 75% of that.
So you're ringing the register.
Absolutely.
Okay.
Yeah.
Okay. So that's exactly the opposite of the scenario I was laying out, which is you buy 100 shares at 100, it goes up to 150, so you go borrow a bunch of money and you buy 1,000.
Right.
Now you're in potentially a dangerous situation.
Correct.
So actually, I think you raised an interesting point here. We talked about one case. This is a case where you figured something out and you were right. How confident are you? Let's say you came into decent money. Let's say you matched a few numbers on the Powerball or whatever. And you got a decent amount of money. So how confident are you that you could quit your job and given a reasonable capital base, let's just put numbers on it. Let's say you got $1 million to play with. So you're not trying to make a living on a $10,000 trading account. You have $1 million to play with. How confident are you could do it?
Well, I mean, let's assume, and I have to assume this way because this is a hypothetical.
Highly hypothetical.
If I take $1 million and I assume I can get 8%, I don't know if that's exactly the number. Okay. 8% a year. That's $80,000. Yeah. I can live off that, and all else equal, one would assume, even shooting darts at a board, I probably can do only as well as the market, so I could get that 8%. I could probably live off of that.
Why even bother though? Like if you're making and there's a third argument actually. So we've talked about technicals, we've talked about fundamentals, and now you backed us into the indexing argument. Whether, by the way, brilliant. Whether deliberately or the line is helping, we've now come to the idea with indexing is that you can't beat the market, you can't do better than the market. Right. So you should just buy, say, the SPY or something and call it a day. Why would you even trade if you think that you can't do better than the 8-ish% you get out of the market?
And that's probably my relative lack of confidence at this point. The answer is I still probably buy into the prevailing predominant literature, which suggests one can't beat the market.
Right.
So I would basically assume, for instance, in that sort of job quitting scenario you presented, that I, through trying or not trying, would only ever basically over a reasonable time frame, let's call it 3 years, would match that market return.
Okay. What would change your opinion of that, of your ability?
I would say, and it's hard to quantify because I haven't really thought about it in a sort of robust way, but obviously it would probably be month in, month out returns that are uncorrelated, and people love talking about uncorrelated returns in a positive
The
way.
Holy Grail, right?
Yeah.
Yes.
Yeah. That I, in a sort of differentiated way, could regularly beat the market. And I don't know exactly what that window of time is. I don't know what that return is on a monthly basis, but I think it would have to be a relatively long time frame.
So maybe a couple years?
Maybe even a year.
A year?
I don't know.
Okay.
I haven't really thought about it fully, but 12 months of returns. The numbers are sort of differentiated from the market return, uncorrelated, and obviously uncorrelated in a better way.
And let's put that into plain English, just for people who might be confused. By uncorrelated, you mean the market goes up, you make more than the market goes up. Ideally, market goes down, you don't lose as much as the market. That's kind of the traditional understanding. Like you have basically, if you're a manager and your index goes down 4%, you can keep your job if you don't go down 4%. Just beat it by a few basis points. But if you're at home and you're looking to pay the bills,
sure, I can't.
The market goes down 4%. Ideally, you'd like to be green. You don't want to go down 3%. You want to be up 4%. You want to be up 5%.
Yeah, ideally. And I think also, and there's at least a moment of humility in the following statement. I would want to avoid the kind of gambler spiral, which is I'm behind this month, I've got rent come due 1/1 or whatever the next month is, and so I'm putting my money on black.
Yeah, and I can tell you, I'm opening my email here because on any given day, I hear a lot of people, like I'm no kidding, I'm looking right here at a message here's a message, somebody just says, help me. So,
SOS.
Literally, I'm looking at a message that says, please help me. So, it is very easy to, whether you've done something stupid or you just had a rough time or you had other bills come up, the reality of trading for a living is a lot tougher than a lot of people
Once
realize.
You're in the mindset where if you have a losing trade and you think, oh, there's the rent or there's groceries, something like that, you've put yourself so far behind mentally, it's really damaging.
That was where I had, as my grandma would have said, a come to Jesus moment, where I remember I was trading with money I could not afford to lose, and I had a few $100 loss day trading stock indexes, and the thought that went through my head was, there went your car insurance payment.
Yeah.
And I knew at that moment, I had enough clarity to know, like, you can't think like that in trade. You somehow have to create the structure where you have the freedom to just do the right thing, which may mean you got to go through some periods of losing money.
Yeah.
There's so much to talk about here. And we're doing this live, we don't chop this up. Tom, where do you think we should direct the discussion? Because I think we could hit on efficient markets. I think we could hit on risk management. I think we could kind of hit on plan for Alex here.
I think we could maybe jump into the plan for Alex.
Okay, we could also open another bottle of wine. I think we can do that after the podcast. So I got to say, Tom kind of gave me a picture that doesn't seem to be completely correct here.
I did?
Yeah. Well, I was thinking that you were going to come in more like a cowboy, guns blazing. Because
Alex was talking a big game.
Yeah.
Sorry, I think I sold false goods.
Well, what I actually hear here is, and it's your time in the industry that's giving you healthy respect for risk.
Yeah.
And for knowing just how ridiculously it's hard for me to talk about trading topics without using 4-letter words. The combination of my time in a professional kitchen, I don't know if he told you I was a chef for a while.
He did.
And time on the trading floor, my language tends to be colorful, and for iTunes we can't do that. But let's say trading is so freaking hard and you have a respect for that. and you also have a realistic humility about your ability to succeed. And I think when you were talking about what it would take for you to have the confidence, it's really wrapping your hands around the data. It's having some kind of evidence. And in my mind, that's something that clearly sets apart the people who eventually succeed at this. They know that at the end of the day, it's about the data, it's about the performance. The people who go into this with the idea of kind of a hope and a prayer, and you're going to go to some website, you're going to see some secret candlestick pattern that only you and 450,000 other people know, and then you're going to go and pull profits out with that. Like, that's not a very realistic way. You have to build up a program that shows some consistency before you can rely on it. You have to see the consistency.
Yep.
So I think, Tom and I discussed this before, you really haven't done much reading or research on technicals at all, right? Is that
no?
accurate?
I have. I studied the CFA program, and there's perhaps a slim chapter on technicals, and no.
Okay, well, I'll tell you. Do you have my book?
I have the workbook.
Okay.
Yeah.
Well, I think we'll give you a copy of the other book before you leave here. I'll tell you the way that I think about technicals is that it is based on movement of past prices. That's what we're looking at. And I think you are exactly correct that it bakes in like all of this analysis, all this emotion. Everybody, behavioral economics is such a buzzword now. Everybody wants to talk about that. But the reality is that I think where we danced around the efficient markets hypothesis without really hitting on it. But I think where the efficient markets hypothesis really fails is this idea that everybody has access to the same information at the same time. Maybe true. Everybody has a Bloomberg, right? And then everybody does rational analysis and makes a decision in their best interest.
Yeah.
That's where I think it falls down, because whether it's deciding what to have for dinner, getting engaged, deciding what stock to buy or sell, every decision we make is both emotional and rational. And I think that one thing that the charts do, and we can talk more about what charts do, but they really do, read correctly, they do incorporate the emotional context of the market participants.
Yep.
And for whatever reason, credit markets tend to lead, right?
Sure.
And just for our listeners that don't know, you can look at the interest rates between high and low risk debt, and that's basically what people are going to charge to borrow money. And when you see that spread widen, some stuff is coming, right? Yeah. And we've seen that historically. So we know that the credit markets tend to be very forward thinking, maybe because we think smart people live in those markets and they do a lot of analysis. We also think the same thing with options, that when you see option implied volatility expand, some stuff's going to hit the fan. But we also see that in price movement itself, if you know how to read it. And I think this is all far, far, far more simple than you think. I've always said that you can put everything on a piece of paper that you need.
Like Warren Buffett.
Let's do that. Yeah. So I think the idea is that you need to be able to separate the big moves from the noise, which is really what basically it's the goal of all data analysis, right?
Right.
And I would submit to you that there are really two ways to do that. One is to use a intermediate term moving average. I made you define intermediate term. I will too. Let's say a moving average, just averaging the closing prices of the last, what do you think, maybe 10 to 50 days?
Yeah, that's a good range.
Maybe 50 is getting a little far, but somewhere in the middle there. I use 20.
Mm-hmm.
So now there's also a lot of voodoo around moving averages.
Mm-hmm.
People talk about the 200-day because people tell us that the hedge funds buy when stocks get down to the 200-day. I'm guessing your hedge fund never did that.
Absolutely. I mean, honestly, moving averages, I probably read about and never was the word expressed in the office.
Yeah.
Sorry.
No,
everyone who doesn't work at a hedge fund thinks that hedge funds use moving averages.
Right. This is the idea that people think that The 50-day is supposed to be magical. Is the 100 magical too, I think?
It's the 20, the 50, and the 200. Those are the most magical moving averages.
Those are the most magical because the idea is that funds do that. And of course, as you and I know, that doesn't happen in any way that I'm aware of.
Right.
And I'll also tell you that I've done a lot of data analysis looking at how price acts around moving averages. And if people buy at the 200-day, like you should see it in the data, right? It's not possible that something is significant, but it's invisible in the data. Like if it works, it freaking works. So, if people buy at these, and so if you look at these different averages, you don't see that there are any special averages. So I am not in the moving average camp, but there is value. And I think you'd probably agree to this with your price inefficiency catalyst idea. There's value kind of knowing, like, are we in a price area the market's generally accepted?
Yeah.
Or has something happened? Have we gotten hit, and are we far from that average? So I think that's one of the issues, is the price movement in relation to a moving average. And the other thing that I would think about is a volatility adjusted move. I'm sure that's probably a concept even as a fundamental manager, like you're familiar with, right? The beauty of this is that you can see both of these on a chart very, very easily. Like all of this, if I want to pull out if I want to like analyze volatility adjusted moves, I have to write code. I probably have to write, in most languages, 10 to 20 lines of computer code. But you can go to a chart right away and you can say, whoa, that's a big move.
Yeah.
Like your eye is drawn to it right away. So I often make the argument that everybody is very suspicious about charts and charting, but a chart is a beautiful heuristic for so many of these things.
Yep. We
We can see, is a price going up? Is a price going down? How is the price moving? How volatile is it? How regular is the volatility? How much, you were out of wine. How much does the volatility change, the volatility of volatility?
I'll take it.
So we just had a little wine passing issue. So that's one thing, to be able to separate the big moves from the noise. And then the whole beauty of technical analysis to me is this idea. The market makes a big move, and then you have some kind of move against that big
Right.
move.
Like profit taking, let's say, or
Profit taking, or the market just gets ahead of itself,
right.
and it can happen to the upside or the downside. We call this a consolidation or a pullback or a flag pattern. The very interesting thing is, like, if you go and read the traditional technical analysis texts where they're talking about pennants and triangles,
Yeah.
there are all of these variations of things.
Rising wedges.
Rising wedges, descending wedges, symmetrical
It's all the
wedges,
same.
it's all the same thing. That's exactly right. That, to me, and I had that flash of inspiration at one point in my career, I realized, wait a minute, all of these, because I was cataloging all these different variations of chart patterns, and I realized it's all the same thing. I didn't sleep for like 2 days. When I realized that all of these subtleties, it makes no difference whether you're looking at a market that goes up and then comes down. It doesn't matter if you have like the two pressing gophers at the bottom, or whether you're at the magical Fibonacci ratio or not. All that matters is that everybody got excited to buy this thing, so they bid it up, and then it probably went too far, so they chilled for a while, and the price went sideways, or maybe it went down, and now we're going to see if there's enough interest to push it up again.
Sure.
That's it. That's all you need. And the same thing works to the downside. And by the way, this is being recorded end of October 2018, and we just had a stock market that's kind of done this and got whacked, and then bounced a little bit and got whacked again. And that's where we are now. So the question is, like, is there enough? Are people freaked out enough here? Is there enough, we would say, downside momentum that for the market to kind of sit here and chill and then roll over maybe into a bigger bear market? That's all you need to know.
Right.
Tom, did I leave anything out?
Nope, we're done. He knows.
Okay, we're done. That's it. Okay, go trade my buddy.
I'd actually make just two comments on the sort of life plan idea. One, you gave me the sort of mental scenario. If I were to quit my job and I had a bankroll,
Yeah.
What would it need to be? I'm not quitting my job, so that's absolutely not going to happen. So any trading regime, program, philosophy needs to accommodate the fact that
Absolutely.
I could only be so involved. Let's call it the like every employee cheats. Whatever that time of day you spend on CNN or Facebook, etc. It would have to be within that window.
Right.
I would say the other point is the following: when it comes to reading charts, obviously a roller coaster from a million miles away looks like a straight line.
Right.
So what I don't fully appreciate, and what I presumably would need to appreciate, is what exactly is that window of analysis, that length of time, where I think you kind of alluded to sort of the separating the signal from the noise, that I'm looking at real movements versus blips in sort of the longer span of the universe.
To your questions, point one, as far as quitting your job, please don't quit your job. I think that one of the dirty secrets of trading, there are all these like crappy, slimy people marketing, quit your job, open a trading account with $3,000 and trade cryptos or penny stocks or whatever garbage you want to trade and make a fantastic living. That is not reality. Tom and I have discussed this many, many times. That is absolutely not reality. When I was at the Mercantile Exchange, and I knew many traders big traders, like $5 million a year plus, consistently for decades, in fact, I think I can say nobody that I knew of, without exception, they had some other income stream.
Mm-hmm.
People have some other income stream, even if, so, it's a little bit bizarre, but you see somebody that makes several $1 million a year trading, and then they have this little business that makes them $30,000, $40,000 a year, but they have to have that. They have to have that regularity. So I think one of the ways that people really shoot themselves in the foot is quitting a job and hoping they're just going to make it trading, because what people don't want to hear is you're probably not. Like that's the reality of it. The other thing is, if you did quit your job, and let's say you quit your job and we magically programmed everything you needed to learn about trading into your head, you would probably discover, if you were what I would call an intermediate term trader, which is going to be shorter than you, so you're holding things for a few days to a few weeks, you would probably discover, what do you think, 15, 20 minutes a day?
Yeah, maybe a little bit more.
Maybe, but I also know people who support their families very well for years, spending 5 minutes a day trading. So then you're so like imagine that you quit your job and you watch everything on Netflix, and how do you feel about yourself when your entire way to support yourself takes 5 minutes a day? It's kind of a weird thing. And then there's this idea that it's this American puritanical, if you don't hate your life, you're not working hard enough. So people find ways to make it harder, but the reality is that trading as an intermediate term trader does not take that much time. Now, to your second point, the roller coaster, I thought that's a good analogy, actually. The roller coaster from far away is a straight line. You have to know that you can choose where you live in the time frame of the market. That's not really very well said, but you could, for instance, be a trader that does 10 trades a day if you wanted to. You could be a trader that does a few trades a week. You could be a trader that does a couple trades a year. Like, you can decide where you are in that spectrum, and that's something you probably need to decide over the next few weeks, months, whatever. How do you want to trade? Because if you're that trader that does 10 trades a day, you got to watch every tick of the market. I've been there. Like, literally, you sit down in front of your screen at 8:30 in the morning, and you basically strap in. You may forget to eat lunch. You may forget to go to the bathroom. You may look at the clock and, it's 2 o'clock in the afternoon. How did that happen? Like, you are glued, and that's obviously not how you can or even want to live your life. But if you for that trader, the tiniest bumps are significant. But if you're on the other extreme, let's say you do 2 trades a year, then you're going to even ignore what happens on a day-to-day basis. You're only going to look at what happens maybe at the end of the week. But if you're this, what I kind of think, frankly, is the sweet spot, where you're doing trades that last, I would say, a few days to a few weeks, you need to check in once a day. You probably need to spend, at the beginning, it's going to be more because everything is kind of new, but you're looking at a time commitment, let's say inside of half an hour.
Yeah, I think that's a good average. Some days it'll be more, some it will be less. You'll learn when you need to spend more time and attention.
And the thing that will blow your mind from a fundamental perspective is once you learn to do this single page chart reading, you will be able to make the decision whether you should buy or sell something in less than 5 seconds. It isn't all, and that's completely counter to the kind of analysis that goes into so much of the industry, but you will just look at it and you will know. And I can tell you're not sure if I'm full of crap yet or not, right?
we're relatively within earshot of Southern Manhattan, home of Wall Street. New York City employs, I couldn't even guess it, but thousands and thousands of expensively educated investors. Only a fingernail of them actually probably follow what you're saying.
So it's true. Yeah. It's true. And I think there are a couple points to that. Wall Street builds this industry that is really designed to keep the industry going. So you hire a bunch of PhDs. You make people think the math is so complicated you couldn't possibly understand it, so you have to hire me to manage your money. There's a little bit of a barrier built up just to keep the industry going. Mm-hmm. And then the other thing is, you and I both know that most people who claim to work in the industry don't make decisions that result in profit or loss.
No, that's absolutely true.
Yeah, like there's a guy, I won't mention his name, there's a guy who claims that anybody online who is not registered with the SEC has no business teaching people to trade. Do you know who I'm talking about, Tom? I'll show you afterwards. Okay. And we know that most people who are registered with the SEC, like they're back office people who never come anywhere near making a decision that involves any kind of risk. Yet there is a small army of people who, and I think where you really see a lot of this is as the trading floors have dried up over the last decade. Some of those people completely went into other businesses. Some of those people have learned to trade for themselves off the floor. And there are people moving significant amounts of money.
I also argue a lot of the Wall Street banks, their strategy, not to get too much into the financial crisis stuff, but their strategies over time are not very profitable because
That's true too.
They try to leverage these short-term strategies to make a little bit of money each year, and then once a decade or however, there's a huge blow up and they lose more money than they ever made in their entire life in 1 year.
Or they're trading off of order flow with, they have access to information that no one else could possibly have.
So, the people at the banks, a lot of their incentive is personal, but not for the bank.
Right.
And all I would ask on that is totally agreed or totally accepted.
Yeah.
I would ask that we put all of these insinuations to the sort of empirical test. So
yeah.
It's true that the banks don't make money. It's true that 90% of Wall Street don't really get into an actual decision-making position. I'm sort of relatively well-versed and trained in the social sciences. I can certainly dust off some old statistical textbooks, but my skepticism is born of the fact that, frankly, technical trading is somewhat maligned
Yeah.
or it's definitely cast aside. But I'm totally open to validating all that we're saying here, or you're saying here more than me. But again, I would want empirics against the allegation.
You should see the proof before you're willing to risk.
Absolutely.
So I think what you should do is you have not been through my trading course.
No. And Tom, as a wonderful birthday gift, gave me your workbook.
Oh, cool.
I haven't had the opportunity to sort of bend the back on that one.
So I think you should just go. And by the way, everybody listening also should go to marketlifetrading.com and just start the trading course. I know that you speak I don't want to say academic in a bad way, but you speak an educated academic dialect of finance. You've been there. You've seen how it works. And I think that you will find in the trading course a fairly rigorous statistical approach. Some of the first topics we talk about the efficient markets hypothesis. We talk about some of the behavioral aspects that are baked in, but it's also very practical. Like, I've scribbled some charts here, but I also want you to think deeply. When you look at a price bar, it's not just a thing that comes up when you go to Yahoo Finance and type in a ticker, like what actually goes into making that price bar. And you've thought about a lot of this, and you because you live through day to day and watching your P&L swing, and you have some ideas. But I think just go through maybe the first. How much do you think you should go through before we talk again?
I think maybe we could have a conversation after the first module.
I think so too.
Yeah.
Go through the first module and then we'll reconvene. Does that sound good?
Perfect.
All right. Cool. Wonderful.
A pleasure.
Thank you, Alex.
Thank you. Thank you very much. I hope you enjoyed that. We had a lot of fun doing it, and it's going to be very exciting to see where this grows over the next few months. I will ask you to do two things for me. First of all, if you have not checked out my course, marketlifetrading.com, please go check it out. If you're listening to this in real time near the end of October of 2018, you can join Market Life Premium with the Pumpkin 15 discount and get a 15% discount off of your lifetime membership. But whether or not you choose to pay me a penny, there is a massive free trading course there that I think you should spend some time with. I think you'll find a lot of interesting ideas there if you've not been through it, and maybe something that can really make a difference for you in your own trading. Second, wherever you found this podcast, please leave a review. iTunes, Spotify, YouTube, subscribe to the channel, leave a review, and tell everybody you know about the podcast, and they should be listening to it. Seriously, the more people who find this, the more content I can produce, and the better it is for all of us. So thank you. I appreciate your time and attention, and thank you for supporting my work. We'll be back soon with another episode.